about some stuff that I just don't see talked about that much about Cardano, here and there and a little bit everywhere, but not enough, and not enough depth to really help you understand what's happening. Because a lot of what's happening with Cardano right now is exactly what happened in 2021, before Cardano went from 2 cents to $3.35 thereabouts, in a matter of like 6 to 9 months. And there are some major differences in what happened then to what's happening now. And in order for you to really understand kind of what's going on, and to kind of put your finger on the pulse of what's happening with Cardano as it's related to the institutions, I've created this whole breakdown I'm going to go through. I love my Claude, let me just tell you, and I love the research capabilities. I love that I've got these little setups where I can do some deep dives and pull on-chain data on all sorts of stuff and put it in a pretty little chart that I can break down for everybody. But we're going to go ahead and dive into this because I want the video to be very focused on this and the information in it. So let's go ahead and get started. And then once I'm finished, I'll cover some of the any comments in the chat and what have you. So the institutions, the institutional crypto. So 6 charts on where institutional capital is moving and where on-chain whales are quietly stacking as the rotation out of Bitcoin sharpens and Cardano's ETF clock ticks toward August. Now, I'm not going to be showing you price data in this. I'm not going to be showing you candles or anything. This is the real data associated with what institutions are doing, as well as some reasoning as to why and what's coming to Cardano to support these institutional decisions and accumulation. And I do think some of these numbers are going to actually shock you, because while there are a lot of bots and retail people that are trying to FUD the narrative of Cardano, right? Because they bought higher and the markets didn't happen the way, Clarity Act threw a big wrench in our progress, and there's so much institutional takeover going on, and a lot of people don't understand. They're used to the narratives being around meme coins and just bullshit gimmicks, right? Like, so many millions, if not billions of dollars have gone into these gimmicks associated with pumping use volume on very specific chains. And it's created these narratives that have been so bought into by end users, retail markets. The institutions don't give a shit about these gimmicks, folks. Just you and your freaking neighbor who just started in crypto yesterday. I've got news for you. Unfortunately, that's the sad truth. So many of us have learned so much about how crypto really works since 2017 and what matters and what doesn't. Depending on where we are in the world and where we are in terms of like where society is and its adoption and interest in blockchain tech, yeah, the gimmicks help play a role, right? Meme coins help, because if you can turn $1,000 into $100,000 overnight because you had some 1,200% pump before the inevitable rug pull of the latest meme coin, then cool. But ultimately, a lot of the narratives related to crypto have all been exploration, experiments, and like what can be done, what narratives make money, and then more money is pumped into those narratives to make more money, and generally not for the retail, right? So to think that because Cardano was never a meme coin farm, it wasn't the biggest blockchain for NFTs or basically any of the more silly gimmicks that pushed a lot of chains into prosperity, really. I think we're going to see some difference in like what the institutions want and what they're caring about and what they're doing about it. So a clean rotation, not an exit. Bitcoin products bled nearly $1 billion, while XRP, Solana, and a handful of mid-cap altcoins absorbed the spillover. The aggregate isn't bearish, it's selective. And you can see now, this is over a period of time, but you're going to see that as all of this money was leaving Bitcoin, it was being put into other things. Because while Bitcoin was, if there's a sell-off or an outflow with the ETFs and things associated with Bitcoin, there was also a big sell-off with Ethereum, and that's still happening right now, we're seeing a lot of institutions get rid of their Ethereum. And that puzzles me a little bit. But where they're putting their money is also very interesting, because some of this money has been going into XRP, Solana, obviously, Ton, Doge, and Link, right? Now, 4 entities, more than 1.6 million Bitcoin. Even with the weekly outflow, the cumulative, excuse me, I'm struggling. The cumulative custody concentration tells the longer story. The top 4 institutional holders together control over 1.6 million Bitcoin, which is very telling. BlackRock, excuse me, the IBIT Spot ETF, Strategy, of course, everybody knows Strategy, formerly MicroStrategy, Grayscale, which is they're growing, they're becoming a bigger and bigger player, and then MetaPlanet, which I'm not even all too familiar with MetaPlanet personally. Oh, okay, it's a trust. All right. So you've got the spot ETFs and corporate treasuries, which is BlackRock and Strategy, and then trust converted ETF and smaller data. Okay. One asset is being bought, the other barely held. Interesting. So per CryptoQuant's data, fund level positioning is decoupled sharply. Bitcoin holdings have risen 92,000 coins since February. Ethereum holdings have shed 127,000. That's huge. And this goes against the narrative of Tom Lee. Unfortunately, he's built an entire fund of some kind around Ethereum, and he's got a lot of lofty claims about where he expects Ethereum to be. I don't fault him. He believes in it. I understand it. I'm a big Cardano guy. I believe in Cardano. It is what it is. We all have our horses in this race. Now, net change in fund holdings between February and May. This is obviously very, very substantial. 92,000 Bitcoin have been accumulated, while 127,000 Ethereum have been dropped, have been sold. Same dollars, very different desks. Cumulative inflows are nearly identical, but the buyer profile is not. Solana's ETF demand is overwhelmingly crypto native institutional. XRP is overwhelmingly retail. That is very, very interesting. Only 16% of the accumulation happening around XRP is institutional. So that is very telling in the sense that, how much impact does the XRP army actually have? Looks like quite a bit. The narrative is strong with XRP. I don't know how many videos I've seen with all of these XRP army members basically going on about XRP being $10,000 at some point. To me, XRP booming into insane profits is almost like every religious group in the world that continues trying to predict the end of the world. They make these huge, grand, lofty, like, this is what's coming, it's coming, the end is nigh, right? And then they keep pushing it further and further when it doesn't happen. I feel like the XRP community is kind of like that. And I'm not trying to shit on XRP. We do the same thing in the Cardano community, okay? Let's be real about it. I've been calling $8 ADA for how many years now? It still hasn't happened. But at the same time, there's a lot more use for Cardano, and there's a lot more tech growth in Cardano. But 85% of the accumulation of Solana has been institutional. And what we're seeing is that a lot of the retail markets have been, a lot of the retail investors have been selling some of these assets and I'm getting to the bigger stuff here in a minute. I'm just kind of proving a point and kind of showing what's happening, not just with Cardano, but across the board with a lot of key altcoins, okay? But Solana's driven largely by industry native capital. This is by Bloomberg Intelligence. The clock is already running on ADA. No spot products yet, but the regulatory machinery has been moving since February. It's just a few months. Rowe Price has ADA at 3.37% in an active fund. Grayscale just rebalanced its smart contract fund in ADA's favor. The institutions are starting to pivot, and there are a lot of reasons why, and we're going to cover some of those here in a little bit. But you can see where a lot of this started. I mean, February 9th, CME ADA futures, 6-month clock, right? A lot of the stuff that's happening right now is being positioned for what's coming but towards the end of 2026. This is good. I mean, look what happened with Bitcoin when that spot ETF launched. Look what happened with Ethereum. Ethereum, it grew, but because of all of the hacks and everything happening on Ethereum right now, and maybe I know not directly Ethereum is a layer one. It's happening on the bridges. It's happening on all the different vehicles related to Ethereum. But the fact is that if you can't expand its use case, and like whether it's the bridges or I mean whatever the vehicle is, unfortunately there are a lot of problems associated with building and trying to establish a basis for growth off of the Ethereum blockchain. It doesn't matter what way you cut the cake is getting sliced and diced, and it's not helping anybody. And it's also not helping the grand Ethereum narrative for institutional adoption or use, especially given the number of years where they have openly tried to copy and emulate a lot of the tech associated with Cardano to fix some of the problems associated with Ethereum. And it hasn't helped them because it was never built that way intentionally from the beginning. At that point, it just becomes about narrative, not actual tech. So whales bought a falling price all year. The most striking institutional signal isn't on a 13F. It's on the Cardano ledger. I'm not sure what 13F is even meaning off the top of my head. While ADA lost over 20% year to date, wallets holding 1 million plus ADA added 410 million tokens to reach an all-time high concentration that we have not seen anything like this since 2020. Okay, this is 6 years ago when we were, and think about it. What happens now, what's happening now, happened around the time Cardano was 2 cents. What does that tell you? Tells you that institutions know a lot is brewing, a lot is coming. 67.47% of circulating ADA now sits in wallets holding over 1 million tokens. The highest concentration since July of 2020, 25.9 billion tokens, an all-time record. So while all of the bots and the trolls and everybody that hates on Cardano because they think they don't think, I feel like they just know it's a substantial threat to the narrative-driven technology and altcoins that they've been accumulating because of so many of the influencers that have been paid very well to project that narrative onto them. I think the proof is in the pudding. And the institutions value things differently than your latest meme coin trader, right? Like it's just a different thing entirely. And we can see some of the charting, basically as the price continues to drop and people start to lose like their interest, the retail market starts to lose some of their interest in ADA because they're seeing all the negativity. They're seeing all this shit. They don't understand it. They're new here. They haven't seen what we've been seeing time and time again, every market cycle since 2017. Because quite frankly, I feel like when there was Bitcoin and Ethereum and some of these other altcoins at the time, it was like Litecoin and so many of the major altcoins that were around in 2017 are not around anymore. Ethereum is, but the majority of them aren't. XRP is, okay, they got caught up in a bunch of SEC bullshit for years that really drug the chain down. And honestly, that is too... I'm glad to see XRP doing well. I don't even hold any right now, but I'm glad to see it was able to spring back and bounce back. I know a lot of people in XRP. Just because I think Cardano is going to do better or ultimately means more and solves more problems for society overall, doesn't mean that I'm a hater. There's really only one chain that I despise, and that's just because everything it stands for is bullshit. That's it. Every other chain I'm rooting for. I'm not like I'm not a Cardano maxi, as it were. I really don't like. It's the same way as I don't like shitty people. I don't like somebody that I feel will stab anyone in the back to get ahead, lie, cheat, steal, do whatever they can to try and, beat everyone around them. I just don't like it. And typically those kinds of people surround themselves with similar minded people. None of them trust each other. Everybody's always watching their shoulder, but they pretend to be good buddies. I feel like that's a lot of the Solana community to me. That's just the way I look at it. Sorry, I'm not sorry. ADA accumulation by wallet cohort year to date in 2026, over 410 million year to date, basically have been accumulated by wallets with over 1 million. The numbers are just growing in that sense. Now, the disconnect, DeFi TVL has dropped 80% from its December 2024 peak to 137 million. Now, this is obviously a big deal, but the reality is with where we're at in the market cycle and the narratives associated with some of these bigger chains with VC backing and all of that stuff, it actually makes some sense because there really isn't much real use case in a lot of this stuff yet. There just isn't. A lot of it is narrative driven. A lot of it is yield driven. I don't know how many different DeFi applications have basically dropped away because, you're going to get this much yield, you're going to make X percentage, APR, APY, all this other shit, and then they get hacked, rug pulled, or whatever, and they disappear. I just think that we haven't seen a lot of that kind of shit happen on Cardano. For one, if I'm honest, I think it's because the chain is so much more secure. It's a lot more difficult to hide these hacks and pretend that they happened from outside sources. I'm just saying, because everybody's a degenerate in crypto right now and has been for a while. And I just think that the technology scares a lot of these more nefarious parties. That's just what I think. Maybe I'm wrong, but we're going to find out. A regime of selected bids. Bitcoin dominant since at roughly 59 to 60%, and the altcoin season index reads somewhere between 39 and 57, meaning we are firmly inside what analysts have begun calling a selective rotation regime. Capital is not flowing into altcoins as a class. It is flowing into specific altcoins that have either an active ETF mandate or an unambiguous filed pathway toward one. This is a big deal, okay? The hierarchy of institutional certainty right now reads in order: Bitcoin, Solana, XRP, Cardano. Ethereum holds a strange position. It is being held as core infrastructure rather than bought as a growth trade, and the fund flow data shows it. The Grayscale smart contract fund reweighing in ADA's favor at Ethereum's expense is a small but telling signal about where allocators are positioning ahead of the next ETF wave. The Ethereum versus Solana composition data is the most useful tell. Both products have absorbed roughly $1.4 billion since November, but the 13F filings, that's what the 13F, okay, that makes sense now. 13F filings show Solana's ETF demand is overwhelmingly institutional, while XRP's buyer base remains heavy retail. I know that was like a dyslexic moment. I rotated those words a little. For desks watching for genuine institutional rotation, Sol has been the cleaner read. Cardano is the asymmetric setup. The on-chain data is doing the talking. 67% of supply concentrated in wallets over 1 million ADA, or holding over 1 million ADA, an all-time high since July of 2020, with 410 million tokens added year to date during a 21% price decline. Rowe Price is positioned ahead of approval. Grayscale is rebalancing in ADA's favor. The base building phase has the same character as the institutional-led accumulation that preceded the 2021 cycle. Quiet, infrastructure-driven, and unreflected in spot price. It's because these narratives help outflow of retail so that the institutions can acquire it cheaper. Everybody is being played right now, plain and simple. So many people are watching the price, not the data. So many people are looking at charts, not what's being done by the institutions behind the scenes as they prepare for what's coming in the not so distant future. And I do believe that there are a lot of reasons. See, here's the thing. If institutions were just entering the Cardano space and accumulating ADA for shits and giggles or just to have it as part of their portfolios or whatever, that would be one thing. But a lot of them, I do believe, are fundamentally interested in what Cardano stands to bring to the table and how it's effectively going to change the entire infrastructure, the entire system of how cryptocurrencies are monitored, used, adopted. What are they adopted for? Security obviously is going to be a major thing. Quantum proof is going to be a major narrative that I do believe is going to continue to grow. And Cardano already has a leg up on pretty much everything else out there as far as its cryptography. So it's going to be very interesting to see how a lot of this comes about. Where the money is stacking. The accumulation isn't one story. It's several catalysts stacking at the same time against a depressed price. That's what makes it look meaningful rather than just dip buying. Okay? 7 distinct forces are converging on ADA at the same moment, each one independently rational, collectively close to overdetermined. Taken individually, any one of them would be insufficient to explain the scale of accumulation visible on chain. Taken together, and they describe a specific kind of positioning trade, one with a known catalyst, a known deadline, and an asymmetric payoff structure that institutional allocators recognize from prior cycles. Number 1, the ETF setup is the proximate driver. This is the largest L1 without a spot ETF yet, and the regulatory path is mechanical now. CME futures launched February 9th. Generic listing standards activate August 9th, and the 75-day SEC review window closes on October 23rd. Grayscale, Bitwise, Canary, 21 Shares, VanEck, and Hashdex all have filings staged. Have you heard this yet? The Bitcoin and ETH or Ethereum ETFs taught everyone the same lesson. Once approved, custody pulls supply off exchanges into hands that don't actively sell. And especially with Cardano, why would you? Because it's generating a passive yield just holding it. And it's not, as I understand it, with the Clarity Act, it's not going to be affected by these rules that the banks are trying to push on everybody, where you can't own a stable coin and can't earn a stable coin yield by leaving it sitting on exchanges. Well, Cardano's not a stable coin, and it produces its own yield as part of securing the network. So that is going to be a big deal for these institutions, because right off the bat, it's accumulating and generating more ADA passively, and it's about to start generating night tokens and other tokens associated with the chains. That's a whole other thing we're going to cover in the future. Whoever's accumulating now is positioning ahead of a known supply shock, not speculating on whether it'll happen. This is such a big deal. This is very, very telling, because what's going to happen is everybody that many of us, Dan Gambardello, myself, and I'm sure there are others who are out there trying to preach to people what is going to start mattering most to the institutions as well as retail as it relates to Cardano and its tech and other chains for their own use cases, okay? We're trying to explain to people why XYZ matters, and to get out of this brain space of meme coins, degeneracy, bullshit. Okay, because so much of what crypto has been about to date has been bullshit. And that's all I can really tell you. There's been so much of it. Many of us that are still here have survived a lot of that bullshit because we've been making more educated plays on what's going to be important. Planning for the future, foresight, right? Most people in crypto, they can't get past tomorrow. What's going to happen tomorrow? What's going to happen today, this afternoon? This TikTok generation, they can't see past their face. So it's very difficult for a lot of these people to wrap their heads around things, especially on a deep technical level. Number 2, regulatory clarity removed the actual gatekeeping problem. I'm going to make this a little bit bigger so you guys can maybe see it a little more clearly. Yeah, that should help. All right. The SEC CFTC joint classification of ADA as a digital commodity wasn't price action, it was permission. A huge swath of institutional capital simply couldn't hold ADA before because of unresolved securities classification risk. Once that risk is gone, allocators with mandates that require commodity classified only exposure can finally buy. Rowe Price putting ADA at 3.37% in an active crypto fund isn't a directional bet. It's evidence that ADA has cleared a due diligence checklist it couldn't clear 18 months ago. Grayscale moving ADA from 17.96% to 18.33% in its smart contract fund while trimming Ethereum is the same signal. Allocator rotation, not retail enthusiasm, because it doesn't have anything to do with retail or dumb money. The institutions aren't listening to the dumb money. They're not on X arguing with people about what's better, right? But they don't give a shit. They already know. The asymmetry is mechanically appealing. ADA is down 70% from all-time high, trading near multi-year lows with a self-funding treasury, predictable emissions schedule, and a 3% staking yield with no slashing risk and instant unbonding, unlike Ethereum. For a portfolio construction model, that profile reads more like yield-bearing bond equivalent with embedded ETF optionality than a growth bet. Boom. What I just said. Whales who buy at 27 cents collect staking yield while they wait. And if the ETF approves, they catch the re-rating. If it doesn't, they still own a yield-bearing position at a low-cost basis. That's a respectable risk-adjusted setup, regardless of whether the catalyst lands on schedule. Bingo. Number 4, Leos is a 30x to 65x throughput leap with a date attached. The single sharpest criticism of Cardano for the last 3 years has been throughput, 5 to 15 transactions per second. Again, I hate this because it's wrong and I see it all the time. It's not just about Cardano is not a 1-for-1 transactions per second blockchain. You can have hundreds of data points within one transaction. So this is effectively just a bunk argument altogether, but it is what it is, and it's about to be resolved anyway. Because I feel like I feel like so much money has to go into the technology related to how Cardano works, just so that the genuine layman's can understand it, just to compete with the bullshit narratives of other chains because of their lack of technical efficiency. I mean, that's basically what it boils down to. And it's pretty frustrating, but it is what it is. On Prouse versus Solana's thousands. Cool. Thousands of transactions a second on Solana. Ouroboros Leos closes that gap quantitatively, not philosophically. Tongue-twisting stuff. Preliminary simulations target 140 to 300 TXBs and peak TPS above 1,500 under realistic conditions. Keep in mind, even when we get to 1,500, it's going to be more like 12,000 because of all the data points, all of the individual items within any one given transaction. I've showed it on the ETUXO website where one transaction or one block gets dumped in and you can see everything inside that one block, right? All of those transactions, how many data points within each transaction. I mean, it's insane, but a lot of people still don't get it. And those that do get it, especially if they're competitors with Cardano, they don't want to talk about it. They don't want to talk about it because it's too hurtful to their narrative. This isn't vapor either. The public Leos tracker shows the protocol at 67% complete with 679,000 lines of code and 35 plus contributors. Public testnet is scheduled for June. Yay, it's coming. June 2026. Mainnet target is end of year alongside the Van Rossum hard fork that activates Plutus version 3 with the protocol version 11 upgrade. The strategic significance is straightforward. Institutional allocators evaluating layer 1 chains compare TPS, and Cardano is about to publish a TPS figure that's in the same neighborhood as Solana while keeping the EUTXO model. formal verification, and decentralization profile that allocators actually wanted in the first place. And if that's not enough, number 5 on this list is Midnight changes who can be a customer of the Cardano ecosystem. Midnight's mainnet launched in March 26 of 2026 with Google Cloud, Telegram, MoneyGram, and Vodafone as federated node operators, not as logos on a slide, but as actual infrastructure participants in the Kokolu federated launch phase. The Mahalu phase of quarter 2 of 2026 opens block production to Cardano stake pool operators and activates the Dust Capacity Exchange. Hooah! Quarter 3 completes decentralization and turns on cross-chain bridges. The product itself is the differentiator. Existing privacy chains are either too anonymous for regulated use, Monero, Zcash shielded, or too transparent for enterprise data, everything else. Midnight's 3-tier model from public access, auditor access, and regulatory God mode using ZK Snarks over Plonk and Halo 2 is the first serious attempt at programmable, selective, auditable privacy. I hope this is all resonating with people. I really do. And I'm hoping this video does what's going on some actual justice for folks. I'm trying to open my little Ani pack here. And it's, what do I have to do? What do I have to do to open this dang gone thing? I push it. Oh, I guess I kind of had to break it a little bit. Well, that's fine. All right. Now, the opening Glacier drop saw 3.5 billion Night claimed across 170,000 addresses, putting Night in the top 100 by market cap within 30 days. The ADA tie-in is direct. Midnight uses Cardano stake pool operators for security and Cardano as the settlement anchor. Every healthcare records app, regulated DeFi venue, KYC gated payment rail, or enterprise data workflow that picks Midnight as its privacy layer is a downstream demand source for ADA staking in Cardano block space. The TAM expansion isn't hypothetical. It's already in production with named Fortune 500 partners. Number 6, the quantum head start is real, and it's already partnered with big tech. On February 13th of 2026, Hoskinson announced Nightstream, Cardano's post-quantum cryptography program developed jointly with Google, Microsoft Research, and the Linux Foundation. The system uses lattice-based cryptography, the leading NIST-aligned post-quantum standard, runs efficiently on AI-class hardware, and is designed to swap in without rewriting Cardano's consensus layer. The IO research proposal for the migration path moved to a community governance vote in May of 2026. I voted on a lot of the stuff related to this on IO. I basically voted in support of IO's efforts and research for quantum proofing Cardano. I voted in favor of all this stuff because I believe in it. I believe if there's anyone out there that's going to pull this shit off, obviously it's going to be IO. And that's it. That's pretty much all there is to it. The structural head start. Okay. Yeah, the structural head start comes from how Cardano was built. The modular Ouroboros design separates cryptographic primitives from consensus logic, so signature schemes can be replaced through a hard fork without re-engineering the chain. Mithril, already live, provides aggregated post-quantum signable checkpoints for historical state, and Cardano's on-chain governance, via DREPs in the Constitution, can coordinate a network-wide migration that Bitcoin literally has no mechanism to execute. Hoskinson's framing, it is very easy to facilitate that migration path. And there's a whole bunch of gobbledygook in here. Compare the field, a bunch of propositions and all kinds of stuff. Voluntary 5-year migration with no coordination mechanism. Ripple, 4-phase roadmap targeting 2028. Ethereum, planning stage. Hedera, Hash based partially there. Cardano actively developing Night Stream with Google and Microsoft today with governance already engaged. Everybody's going to be trying to play catch up. What's funny is Cardano started as the slow tortoise, the slow turtle. Everybody's like, this is going to be the tortoise and the hare and all of that. And it has been, right? But it's about the tides are turning because a lot of the work that Cardano's already put into future tech and future proofing the chain at launch, when it's been done, it was done right, properly, and with scale in mind. And with all of these other things that are going to be necessary for a layer one blockchain already in the pudding. Whereas everyone else is now saying, well, we built fast to break things. Now everything's broken. Everything is changing so quickly in the world, from quantum proofing technology necessary to AI and all of these different things, identity, all of this. Now that the narrative is changing, everyone is starting to play catch up while Cardano is at the front of the line. Google's quantum AI team revised its estimate in March. Bitcoin's elliptic curve cryptography could be broken with under 500,000 qubits, well below earlier projections. Some analysts now flag 2029 as a deadline for the broader ecosystem. Cardano will be the chain that doesn't spend 2027 and 2028 explaining what its plan is, because the plan is already executing. And you can preach this shit till you're blue in the face, but I tell you what, some of these other folks out there, they just don't get it. Number 7, last on this list, the 2021 setup pattern is recognizable. The current price accumulation divergence looks structurally identical to the 2021 base building phase that preceded ADA's run to $3. Quiet institutional and infrastructure level interest building during retail disengagement. Whales who lived through that cycle recognize the shape, as we do, as we've pointed it out many, many times. Multi-year accumulation since December 2023 isn't a tactical trade. It's a cycle position thesis. The fact that the largest wallet cohort has added to its position through every drawdown in the past 18 months tells you what time horizon the buyer is operating on. This is no longer just an ETF positioning trade. It's an ETF setup stacked on top of quantitative throughput leap, a privacy layer partnership with big tech, and a post-quantum migration path that's actively in development with Google and Microsoft. While every other major chain is still at the planning stage, the risk isn't that the thesis is wrong. It's that retail wakes up only after the catalyst compound. Basically saying, if you're a retail investor and you're not into Cardano, or you're waiting, or you're screwing around with other chains because you want the next pet rock to be, worth $1 billion tomorrow, and you're buying into that bullshit, hoping you don't get rug pulled, you're playing yourself. The institutions know what's going on. They know what's happening. They're lining up. The papers are filed. Everything's ready and waiting. More are going to be joining them. Hell, even Motley Fool has been a proponent of Cardano now for a while. And I don't understand how the confusion is still there. The proof is all sitting right in front of anybody that wants to look. Chances are this video is 38 minutes. I've laid down so much of what's been happening with Cardano and other chains, the accumulation, the whales, the this, the that, and a whole other thing. Most people only got through 8 minutes of it and checked out, and they're probably watching a fucking short clip on TikTok with some woman shaking her ass, or some video promoting some other bullshit rug pull meme coin. It is what it is, and there's just not much you can do to help those people, but I'm trying to do everything that I can. If you're into this sort of thing, make sure you subscribe to this video. Help my chain. Help stop the bleeding of subscribers, because you know what? Whether you like me or not, I give it to you straight. And I'm not just a hater of other chains at all. I'm just tired of the competition, the bullshit, and the narratives put out by other chains that are always trying to push Cardano underwater so that they can keep themselves floating in a house of cards that really doesn't even belong in the space much at all. I shouldn't say that. Some of these chains definitely have a space, okay? And some of them are just built fast but honest. Some of them I just don't believe are honest on any freaking level whatsoever. And the only thing that ever matters to them is how much money they can make from the retail markets that are supporting them. And I've never looked at Cardano as being one of them, because it's not. I think if anything, there's a lot of narcissistic projection of other chains that are trying to paint Cardano to be what their favorite chain actually is. They see it, they experience it, they witness it, and they don't want to be alone. So they try to create these narratives around competing chains that are ultimately going to eat their freaking lunch. So that's it. That's all I really have to say. I just wanted to share this because I thought it was a big deal. And, make sure you hit the like button if you don't mind. Leave your comments down below so that YouTube says, you know what, this old guy, he's not done yet. He's still here. He's still supporting the ecosystem and everyone that's a part of it. And, spread the message, spread the love, spread the joy. And until next time, crow your coins, and I'll see you again soon. Thank you for joining me.